Krishna Karwa is Managing Director at Emkay Global. He's joining us right now to take some questions. Mr. Karwa, good morning. Good to have you with us here. Thank you for your time. Just weigh in there, especially on the main small micro cap part of the market and the pace of gains, etc. The momentum is strong. What's your sort of gut feeling? Is there way more to go? Are you seeing some dissonance out there, or all okay? Go on.
I think the party has been on for the last 3-4 months, and investors are very happy because of the breadth of the market has been very good. So, question is, as you rightly said, that from here where my sense is that still there is a lot more steep to go in individual stocks. I think a lot of catching up, or individual sectors. So a lot of catching up is going on now in terms of sectors which have not performed so far in terms of relative valuations, and that is where you are seeing many sectors catching up. So I think there is the whole breadth of the market being what it is. You will see some rotations which will keep on happening. Plus, there is a lot of feeling of left out also amongst investors. So even if you see some corrections happening, the sense is that at every dip there would be more money coming in from retail investors and also global investors. So there is a FOMO feeling which is very much there. So I don't see any sharp corrections across the market. Individual sector stocks, I think that rotation will keep on happening.
Okay. Mr. Karwa, good morning and thanks for joining us on the show. You know, this is a market where some people are calling it euphoric, but a lot of people believe that perhaps there's still a lot more upside in mid-caps and small caps despite the rally. How are you approaching it from that perspective? Do you think the time has come to churn back into large caps because of the kind of, froth that we're seeing in the mid-cap and small cap space? And what's the best approach?
See, if you look at the large cap indices, I think almost 60% of the Nifty is comprised of basically banks and IT and oil and gas. So there you don't get an opportunity in terms of the breadth of the market. So that's why if you see banks have underperformed, and even IT had its own reasons to kind of being subdued. And you see that Nifty have only given, say, around 10% kind of return year to date versus the breadth of the market as far as the small mid-cap segment is concerned, or the broader market, is phenomenal in terms of the various sector exposure, even the indices which they which track the small and mid-cap indices. So that's plus the opportunity as far as the overall India growth story is concerned. I think the capex cycle, the way it is panning out, and also the opportunity in the renewals, etc., also in terms of defense or in terms of railways. So the whole breadth of the market is that's where the opportunity is in the small and mid-cap segment. And that's why you see the kind of outperformance which is happening. So coming back to a question about rotating back from from small and mid caps to large caps, I think investors would do well to understand that which segment of the market they are looking to participate in and accordingly participate. Having said that, my sense is that the valuations of most of the banks are very, very reasonable. So to that extent, yes, incremental money could possibly be invested in the whole banking sector where valuations are reasonable, and could be that could be the segment which could deliver superior returns in the medium term.
Will that also be boosted by the RBI's latest move to gradually remove this ICRR and free up a little more capital for banks? That was a recent announcement. Is that a big positive as well?
These are all minor incremental positives. I think you should look at it from the growth itself, the banking sector, the kind of growth that most of the banks are expected to deliver, and also the profitability. So they are in a sweet spot as far as their own capital adequacy, etc., NPS recognition. So they are also having a lot of tailwinds. I think only challenge is that maybe some interest costs deposit rates are moving up. So maybe there could be some pressure of NIMs. But if valuations being what they are for most of the banks and the relative underperformance that we are seeing of these banks versus the broad market gives me reason to believe that that could be the space where investors could rotate into.
Hi, good morning, sir. I wanted to ask you about two spaces which looked very promising and there are a lot of tailwinds, but how much is in the price? One is the railways and the other is defense. So these stocks have done very, very well. I don't know whether they're factoring in 2025, 26, 28. I'm not sure what earnings they're factoring in, but these stocks have done well. Your view on the space from here on?
Absolutely. I think the tailwind, no doubt about it, and the returns that many of the companies which belong to that segment have delivered phenomenal returns. Currently, there is a huge momentum as far as the defense companies or the railway companies are concerned. So that momentum in business is no doubt about it. Maybe as far as investors are concerned and valuations are concerned, maybe we have run ahead of the curve. So there could be maybe some consolidation, some price correction. So investors should be very careful about investing in this segment of the market. I'm not saying that the opportunities are not there. I'm only worried. I agree with you that the valuations possibly are discounting, maybe not even FY25, FY26. And typically, my rule of thumb is that if we believe that the best is discounted 3 years forward, then you should take some money off the table.
Okay, all right. On that very sane advice, thanks a lot for joining in, Mr. Karwa. Always great speaking with you. Appreciate your time here on CNBC TV 18.